Welcome to Moneyman. This is long story short, where we try to cut through long narratives, long stories, come to the crux of the matter, and give a very short update, quick and very effective update on any particular asset class or segment or sector. And today's call of the day is obviously precious metals, gold and silver. Considering how everyone is talking about it, it's extremely important to really cut through all the narratives and see what is really going on. There's a bit about Moneyman, just a quick brief about who we are and what we do. This is our disclaimer, statutory disclaimer as per SEBI. You can also read this on our website www.moneyman-research.com. Let's dive in. Precious metals. So what is happening today really? Every single person is a gold bull and silver bull. Every single one. There's not a single person who feels that this could come down. And that in itself is the first warning bell that rings. You know what they say about, what they say in the stock markets about when the last bull also turns into a bear, or the last bear also turns into a bull. That is when the markets reverse. Today seems to be that particular point in time because everyone seems to be a gold bull. And every single day there are new narratives coming in to justify prices, and not only prices, but also how these prices will sustain and go up further. People don't talk about anything less than doubling of prices from here. Every single day, new justifications, new narratives. The latest one doing the rounds is how there is a huge shortfall in gold mining, how there is a huge shortfall in silver mining. The other narrative that has started coming in is how AI is going to need loads and loads of silver, and that is why prices are going up. Of course, they have to bring AI into this, right? Everyone is riding the AI boom, so why not precious metals? Now the thing is, every narrative that is coming in as a justification to these high prices and as a justification to how prices should go further up are not new. They are not unforeseeable. A shortage in precious metals does not suddenly happen in 2 weeks. Requirement of AI for a higher amount of silver does not happen in 1 week or 2 weeks or 3 weeks. Central banks buying gold has not been happening since a couple of months. It's been happening since the past few years. But why suddenly? Why suddenly do prices go up and more narratives keep coming in? It's an interesting point to think about. So what does gold really do? Is there an intrinsic value to gold? Have you ever thought about this? Gold is a piece of rock at the end of the day. It's a precious metal. But it technically has no intrinsic value because it does not produce anything. There is no profitability. There is no cash flow. You know how a company is, or how a share price is, how you can value internal intrinsic values of anything depending on the asset. Use various methodologies, but essentially come to a point where you understand what does it produce really. Gold does not do anything. Gold is a precious metal. So the entire intrinsic value that is derived in gold is from the liquidity that chases it. Please understand this. Gold per se does not have its own value. It was not born with a particular value. It is a liquidity that chases it that determines what value it is today. If today it is at X value and 1 year back it was half of this, that's purely because of the liquidity that was chasing it. And the moment this liquidity goes, you know what will happen, right? Now we are looking at a lot of new crises coming in on a daily basis. Last week we saw a huge pricing mismatch in ETFs, especially in India and especially in silver. What was this pricing mismatch about? On the exchanges, ETFs were trading at about 15 to 20% premium to their intrinsic values. intrinsic NAVs, which are basically determined from uh, the spot prices of that particular metal, in this case, silver. Why was that happening? See, what happens is when you put money into an ETF, the mutual fund is supposed to give that money to a market maker who purchases the underlying, which is silver in this case, and determines that so much worth of silver has been bought. But apparently in the last week, these market makers were not able to procure enough silver to meet the demand that was coming in from these mutual funds. As a result of which, they were just getting traded at a much higher premium. Now think about this, 15 to 20% premium to its intrinsic NAV, intrinsic value. Or look at it this way, 15 to 20% premium to the current spot prices. That's huge, right? That means people have bought at this premium. This premium is basically for nothing. You're just giving in to euphoria and FOMO and just paying a premium just to get into that asset. It's basically money lost. Now, while most of the mutual funds haven't done anything, one particular mutual fund actually stopped fresh inflows into its silver ETFs, which is a good thing, but most of the others haven't done that, which means they're letting their investors get taken on a ride. Remember that. There is a lot of euphoria, lots. As soon as there is euphoria in any market, it basically means alarm bells for me. That's when alarm bells start ringing. A lot of retail money has started flowing in. It has started flowing in, by the way. A lot of institutional money was positioned from much before. But a lot of retail money has started flowing in since the past month or two. A lot of fresh SIPs have been started in gold ETFs and silver ETFs in the last 1 month. Think about this for a minute. Why does this happen? Mutual funds are essentially sold by distributors. Distributors determine which is the correct mutual fund and they just tell the retail investor which one it is. And the retail investor usually buy into the logic offered by the mutual fund distributor that if the last year or last segment or last quarter or last whatever time period, that particular mutual fund performed really well, it means that it will continue performing in the same way. Even though mutual funds have a disclaimer saying that past returns are not an indication of the future returns, unfortunately, that's how distributors use it to sell mutual funds. And as a result of this, a lot of retail money has actually started flowing in now. Usually when retailers catch on to euphoria and FOMO, that usually indicates kind of an intermediate top in that asset class. Always remember this. It has always happened. It will always continue happening. And I'm just seeing this happen in gold and silver right now. Now the issue with all of this is somehow this has become the new sure shot trade. It seems as if gold and silver cannot do anything wrong. It is being made out to be as if the prices of these will keep increasing and keep increasing. There is no, downside to this particular trade. That's how it is being made out to be. Remember that. I'm not saying that. I'm just pointing out what people are talking about. The same market experts who for the longest time kept showing data of 20-25 years on how equity has outperformed gold have suddenly switched sides and now are talking about how gold is outperforming equity, all because of 1 year returns. Remember, these returns are outlier returns in nature. They are not something that has been sustained over a period of time. Important to know this, that these are all outlier returns. Now there is something about something becoming a new sure shot trade. It almost always does not sustain. See how people have been really putting in loads and loads of money into gold-backed ETFs. September has seen one of the highest in the last almost 3 to 4 years. So much inflow. Now the point is, will this money make so much Returns, it's a big question mark. Look at the data point on the right side. Holdings of US ETFs linked to physical gold has gone up hugely. And that is where the new narrative that there may not be enough gold comes in. But it doesn't happen like that. Sorry. What people have to understand is that this particular year, 2025, is actually a huge outlier. Look at this. It's not that gold has not beaten. I'm saying gold again and again because silver is primarily mirroring gold moves. So that is why it is important to look at gold. Gold, only this year has it shown outlier returns, but otherwise it hasn't. Over a longer term, it is equity that has beaten gold. And this chart shows that clearly. However, the narratives that are shaping up now are that this is how it is going to be. And various words being woven into this. De-dollarization, debasement, whatnot. The point is, people need to understand this is just an outlier right now. And look at this particular data point from Bank of America. If you look at a combination of gold prices and oil prices and how they have behaved on all of this data is on a year-on-year basis, 2025 is probably one of the outlier years, very, very few outlier years where gold has gone up in a big way while oil has come down. Look at the number of outlier years that are there. Usually this entire data point, it is clustered around here. So there is more and more data that shows that 2025 is nothing but an outlier year. Extremely important to understand that. Because people are entering into this asset class thinking that this is the new big thing, the next big thing, the current big thing, which is going to continue to be the big thing for the next few years. And people feel that this is how returns are going to come in. That's not going to happen. There's a lot of FOMO driving this. Let's look at what the charts are saying now. This is a monthly chart of gold. What I have plotted out below is something called RSI, Relative Strength Index. It's a technical indicator which shows the strength of the move that is going up right now. It also shows when the asset starts becoming overheated or overcooled. Now look at this particular point in 2020. When gold prices hit their peak, got really heated up somewhere around July. And what happens when this particular asset class gets heated up a lot? It goes sideways. And do you know for how long did it go sideways? 29 to 30 months. 29 to 30 months, that is right. That's about 2.5 years. Now we are seeing something similar happen again when the price has gone near vertical and it is again very, very, very heated up. Imagine this kind of price rise. How much time would it take to digest that entire up move and just go sideways? There's something more interesting on the weekly chart. This is the weekly gold prices, and what I've done is outlined every single time in the last about 5-6 years when this particular asset class has got overheated. These vertical lines indicate that particular week, and see what has happened after that. Every single time they've gone sideways or down, and for a sustained amount of time. This again here, this again here. This is a time in 2025 when for the first time they went sideways and very volatile, and now they've gone vertical and again overheated. Think what is going to happen here. Now there is no asset class that can keep going up and only up. The same thing with silver. All these lines indicate how whenever this particular asset class has gone really like heated up, it has gone sideways for a long time after that. And we are again somewhere there, probably at the highest that it has ever achieved in terms of overheating till date. What it also indicates, something that I have not shown here, is that there is, especially in the last week, there is a huge volume that has got sold off this particular candle. And these times usually indicate a top. Now, while it is impossible to while it is impossible to exactly time the market and call a top, I think we are somewhere there for sure. Now, this is a ratio chart. I use ratio charts to understand how asset classes are behaving relative to each other. And this is a ratio chart of gold versus equity. Now, Nifty 500 is kind of like a benchmark for the overall broad markets. Look at these red arrows. What they indicate is that every time gold has majorly outperformed equity and there is a divergence shown, we've also seen that particular thing followed by a sideways or a downside movement, which means that after a sudden spurt of outperformance of gold vis-a-vis equity, for a long time, it has become an underperformer. I think we are reaching there once again, or we've already reached there. And this particular line is today kind of like a resistance zone to the outperformance. That means that somewhere we should now take a breather. Now, the ideal thing to happen for gold and silver from here onwards is that it takes a breather, goes sideways for a fairly decent amount of time. That would be a healthy consolidation. But if the same thing does not happen and it starts and it keeps moving up again, there is a risk of a big crash coming in. This is something that we need to keep in mind going forward. So is it a good time so what do we make out of all of this? Is it a good time to invest in gold and silver right now? Definitely no. People are justifying that they will be starting their SIPs or continuing their SIPs or investing for the long term, which is 3 or 5 years. But the point is, gold has a habit of going sideways for 2 to 3 years very easily, at the least 1.5 years. What happens during these times is that equity starts outperforming. So imagine it this way. Look at the psychology that is going on behind it. People are taking out money from equity because it has not performed in 2025. And they are investing out of FOMO and out of euphoria in an asset class which has gone up too much and has become overheated, which is precious metals, gold and silver. So the money comes out of their equity kitty, goes into gold, and gold or silver here, if they go sideways for the next 1 to 2 years and equity outperforms, these people miss out on those returns also, because now they're sitting on a dud asset. And we all know that retailers usually don't sell so easily. They wait and they wait. This is exactly how retailers keep underperforming the market. So look at the psychology. People who have invested into gold much before, maybe about a couple of years back, for them it's a great idea to start taking out profit. In fact, I believe that in the last week specifically, there is a lot of profit taking that has happened in both the asset classes, lots. Now I also know that big money abroad was short on gold at least 20% below current prices. 20% below current prices, imagine. So they've been carrying those shorts for a long time. The short covering has not yet happened. People are hoping that it will happen, but this is big money, patient money. Looking at what has happened in the last 1 week, with a lot of profit booking already started happening, it is fair to say that the time has come where upsides are going to be very limited. If they are there, that is, if they are there, they're going to be very, very limited. And there is a higher probability of this particular asset class, that is gold and silver, precious metals, going sideways for a long time. And during this time, equity is more poised to take the lead. Now you decide what you want to make out of this and choose your plan of action going forward. I hope this was of value to you. Thank you for your time. Whenever I get the time, I'll keep trying to make such videos to explain all these important things. Once again, thank you very much.